So what if I told you the very foundation of our financial world was being rebuilt right now, right under our noses? Today we're digging into a really bold theory about a $300 trillion shift. The idea is that the entire Wall Street bond market could be migrating to a brand new digital system. Let's break down what that even means. All right, here's the plan. First, we're going to try to get our heads around the sheer scale of this thing. Then we'll ask, hey, what's so wrong with the credit system we have now? From there, we'll get into the digital capital that's at the heart of this idea, see how it supposedly works, and figure out why some are calling it a Trojan horse for Wall Street. And finally, we'll bring it all back home to what it might mean for you as an investor. Okay, let's dive right into the core idea. The theory we're exploring today suggests nothing less than a massive, tectonic shift in the global fixed income market. And that market, well, it's the bedrock of all of modern finance. To really get this scale here, just look at this number, $300 trillion. That's how big the entire global fixed income market is estimated to be. We're talking about all the government bonds, all the corporate debt, pretty much every savings product in the world. And the theory is that this entire mountain of capital could be about to move. So this is the central question we have to ask. We're not talking about a small tweak here or some newfangled product. We're talking about a complete teardown and rebuild of the system that holds up global finance. And to understand why anyone would even propose something so drastic, we've got to look at the foundation of the old system. So why the need for such a radical change? Well, the theory argues that the old credit system, the financial world we live in right now, is built on some increasingly shaky ground. Here's the fundamental problem, as the theory sees it. Most of what we think of as money isn't really cash, it's credit. We're in a debt-based system. That means new money gets created not when we produce something of value, but when a government issues a bond or a bank gives out a loan. At its core, our entire global financial system is built on a foundation of IOUs. And this is where the risk creeps in. The argument is that this foundation of fiat currency, basically government money that isn't backed by a physical thing like gold, is starting to crumble. It's constantly at risk of inflation, which quietly eats away at your savings. And then there's counterparty risk, the chance that the other guy in a deal just can't pay you back. And yet we just keep piling more and more credit on top of this weak base. So this brings us to the proposed solution. If the old foundation is flawed, the theory says we need a new one. A new digital capital, something built from the ground up specifically for the digital age. And this comparison really says it all, doesn't it? Instead of assets that can lose value over time, the new foundation is built on an asset that's designed to appreciate. Instead of being inflationary, it has a fixed, totally scarce supply. And it swaps out slow, physical systems that have counterparty risk for a digital, instant system that, in theory, has none. And this digital capital is, of course, Bitcoin. This quote from the source material really just nails the whole argument. It's basically a modern update on that old JP Morgan saying, gold is money, everything else is credit. The whole point is to frame Bitcoin not just as some other investment, but as the base layer money, a new digital gold that the entire next generation of credit can be built on top of. Okay, so that's the big picture theory, but how would any of this actually work in the real world? This is where we get into the nuts and bolts, and what the source describes as a really powerful flywheel effect. It's laid out as a 4-step loop, and it's pretty straightforward. Step 1, a company that has Bitcoin on its books issues some kind of credit. Step 2, they take the dollars they raise from that, and, you guessed it, they buy more Bitcoin. Step 3, this new Bitcoin makes their own financial position, their collateral, even stronger. And step 4, because they're stronger, they can now issue even more credit, and the whole cycle just starts all over again. And what's the end result? Well, this flywheel is basically designed to be a self-powering engine. Every single time the wheel turns, it converts dollars from the old system into the new system's main asset. This makes the supply of Bitcoin tighter, which strengthens the collateral, which then allows for even more credit to be created. It just feeds on itself. And now we get to the really disruptive part. The theory actually calls this Wall Street's Trojan horse, which is a pretty vivid way of describing how this digital credit system could sneak in and pull trillions of dollars right out of the traditional financial world. And the potential scale of this whole thing is just immense. Remember that $300 trillion market? If just 1% of that capital moves over to this new digital system, that's a $3 trillion inflow. At 10%, we're talking $30 trillion. I mean, the numbers are just staggering. The source even gives this a really provocative name, a speculative attack on the dollar. And it's called an attack for a very specific reason. The very act of creating credit in this new system is funded by dollars, right? But those dollars are immediately converted out of the dollar system and into Bitcoin. So it's actively weakening the old system while at the same time strengthening the new one. Okay, so that's the massive, world-changing theory. But let's bring it down to earth for a second. What could this mean for an individual investor? Our last section here looks at the potential new options for investors that a system like this might create. So according to this theory, this new ecosystem could have options for all sorts of different risk levels. If you're a conservative investor, you might look for instruments that act kind of like a high-yield money market account. If you're more balanced, you could check out something that pays a dividend but also has some room for growth. And if you're an aggressive investor, well, you could just buy stock in the companies that are running this whole flywheel and go for pure upside. And that really brings us back to the core question, doesn't it? On one hand, this theory presents a brand new financial system built on digital capital that promises higher yields and maybe even greater security. But on the other hand, it frames this whole shift as a direct challenge to the system we have right now. So are we watching a financial revolution that could end up benefiting savers everywhere? Or is it a speculative attack that could destabilize the very money we all use every day? That's the multi-trillion-dollar question, and the answer is still being written.